In this video, we'll show you 3 growth stocks that could be setting up for their next major breakout, and why the market may still be underestimating their long-term potential. These are businesses that continue to expand despite economic uncertainty, are strengthening their competitive positions, and still trade at valuations that could leave meaningful room for future upside if execution continues. Some companies become bigger simply because they sell more products. Others become bigger because they build brands, ecosystems, and customer loyalty that competitors struggle to replicate. The 3 businesses we'll cover today fall into that second category, and each has a different path toward creating shareholder value over the next several years. Let's begin with the first stock. Our first growth stock is ONON, ticker symbol ONON. Sometimes the best investments are hiding in industries that people think are already mature. Athletic footwear has existed for decades. Consumers already have plenty of choices. Competition is fierce. Yet every once in a while, a company introduces something genuinely different, captures consumer attention, and slowly transforms from a niche premium brand into a global powerhouse. That is exactly what ONON has been doing. What makes this company particularly interesting is that it has not relied on aggressive discounting or flashy marketing campaigns to drive growth. Instead, it is focused on creating products that people genuinely enjoy wearing, whether they are elite runners, fitness enthusiasts, or everyday consumers looking for comfort. Its innovation-first approach has allowed it to carve out a distinctive identity in performance footwear. One of the biggest reasons investors have become increasingly optimistic about the company is its ability to consistently deliver strong growth even while many consumer brands have struggled with weaker spending. Despite macroeconomic headwinds around the world, demand for ON products has remained remarkably resilient. During 2025, sales increased by an impressive 35% year-over-year on a constant currency basis. Then, instead of slowing dramatically, the momentum continued into 2026. During the first quarter of 2026, revenue climbed another 26% year-over-year. Those are exceptional growth rates for a company that has already achieved significant scale. When investors look for long-term compounders, consistency matters. One great quarter can happen for many reasons. Several years of strong execution are much harder to achieve. ONON has demonstrated that its momentum is not a temporary trend. The company's products continue attracting new customers across multiple international markets, while existing customers continue buying additional products. That combination is incredibly powerful. One reason consumers continue returning to the brand is product innovation. Innovation in footwear sounds simple until you realize how difficult it actually is. Customers notice comfort immediately. They notice performance immediately. If either one disappoints, they simply buy another brand next time. ONON understands this. Its CloudTech cushioning technology became one of the company's defining features because it created a distinctive running experience. Rather than standing still, the company has continued improving that technology. One of its newer innovations, called CELH, combines the popular CloudTech cushioning system with additional foam technologies to create an even softer ride while still maintaining responsiveness. That may sound like a small improvement. It is not. In footwear, incremental improvements often create enormous competitive advantages because satisfied customers become repeat buyers. The better the running experience becomes, the stronger customer loyalty grows. Customer loyalty eventually creates pricing power. Pricing power is one of the most valuable characteristics any business can possess. Companies with pricing power do not need to compete primarily on discounts. Instead, customers willingly pay premium prices because they believe the product delivers superior value. That is exactly what has been happening. Average selling prices have increased from roughly $145 to more than $170. Normally, higher prices would slow demand. Instead, demand has remained incredibly strong. That tells investors something very important. Customers are not simply buying based on price. They are buying because they believe the product is worth paying more for. Few consumer companies achieve that level of brand strength so early in their life cycle. Higher selling prices are also helping profitability. Growing revenue is important. Growing profits at the same time is even more important. Over the past year, the company's profit margin climbed above 8%. While there is certainly room for additional improvement over time, expanding margins suggest management is building a healthier business rather than chasing growth at any cost. That distinction matters. Some rapidly growing companies eventually disappoint because profits never materialize. ONON appears to be moving in the opposite direction. Revenue continues climbing, margins continue improving, the overall business becomes stronger. Another encouraging sign comes from retailer demand. Retailers pay very close attention to customer purchasing behavior. They know which products are sitting on shelves. They know which products consistently sell through. When retailers place larger future orders, they are effectively signaling confidence that customers will continue buying. Management recently reported that its running order book increased by more than 25% year over year. That tells us retail partners remain highly optimistic. Strong wholesale demand often creates good visibility into future revenue growth. It suggests current momentum may not disappear overnight. Beyond the numbers, one of the biggest reasons investors remain excited is the enormous runway still available. Management believes global brand awareness remains relatively low. That may actually be one of the company's greatest strengths. Many of today's largest consumer brands became dominant because they expanded gradually into new international markets over many years. If awareness remains relatively limited today, future customer acquisition opportunities could remain substantial. This is particularly important because the addressable market for athletic footwear and apparel is enormous. Even capturing a modest additional percentage of that market could translate into billions of dollars in future revenue. Another attractive aspect of the investment thesis is valuation. Fast-growing companies often trade at extremely expensive valuations. Investors become so excited about future growth that they bid shares to unrealistic levels. That does not appear to be the case here. ONON Holding currently trades around a forward price-to-earnings multiple of approximately 22. Considering its revenue growth, expanding profitability, premium brand positioning, and long runway for international expansion, many investors would argue that valuation remains surprisingly reasonable. Valuation alone never guarantees future returns. Execution always matters. But when a high-quality growth company continues delivering strong financial performance while trading at a multiple that is not excessively stretched, investors naturally begin paying closer attention. There are still risks. Consumer spending could weaken. Competition will always remain intense. Fashion trends can change. Currency fluctuations can influence reported results across international markets. These are legitimate considerations. However, what separates stronger businesses from weaker ones is their ability to continue innovating while strengthening customer relationships. So far, ONON Holding has demonstrated exactly that. Instead of relying on one successful product, the company continues expanding its product lineup. Instead of sacrificing profitability for growth, margins continue improving. Instead of depending on one geographic market, international expansion continues opening new opportunities. Those characteristics often define businesses capable of compounding shareholder value over very long periods. When you combine sustained double-digit revenue growth, increasing profitability, premium pricing, growing retailer confidence, product innovation, and a still-developing global brand, it becomes easier to understand why many investors believe ONON Holding could still be in the relatively early stages of a much larger growth story. Sometimes the biggest winners are not necessarily the companies everyone already knows. Sometimes they are the companies quietly building loyal customers one purchase at a time while steadily expanding around the world. ONON Holding appears to be following exactly that path. Whether it ultimately becomes one of the dominant athletic brands of the next decade remains to be seen. But based on its recent execution, the opportunity certainly appears larger than many investors may currently appreciate. If this resonates with you, you're exactly who this channel is for. Please, hit the like button, share the video and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Our second growth stock is eBay, ticker symbol EBAY. There is a common mistake investors make when evaluating businesses. They often assume that if a company has been around for a long time, its best growth days must already be behind it. History has shown that this assumption can be very expensive. Some businesses stop innovating and slowly fade into irrelevance. Others reinvent themselves, improve their products, modernize their platforms, and unlock entirely new growth opportunities. That second scenario is exactly what has been unfolding at eBay over the past several years. For a long time, many investors viewed eBay as a mature marketplace that had already reached its peak. Revenue growth slowed, competitors captured headlines, and Wall Street gradually shifted its attention elsewhere. But beneath the surface, management was quietly rebuilding the business. Instead of trying to become everything for everyone, the company focused on becoming exceptional in categories where it already had unique advantages. That strategy appears to be working. One of the biggest reasons eBay matters is that it operates one of the world's largest online marketplaces. Its platform connects millions of buyers and sellers across numerous categories, creating a marketplace where inventory constantly refreshes itself. Unlike traditional retailers, eBay does not need to own warehouses filled with merchandise. The marketplace grows because users bring products onto the platform every single day. That asset-light business model gives the company attractive economics and allows management to focus on improving the customer experience rather than managing massive inventories. Under CEO Jamie Iannone, who took over leadership in 2020, the company has become much more disciplined about where it invests. Rather than chasing low-quality growth, management identified categories where passionate communities already existed and doubled down on those opportunities. Collectibles became one of the biggest success stories. Collectors are different from ordinary shoppers. They are highly engaged. They frequently return to search for rare items. Many become repeat buyers and repeat sellers. That creates a healthy marketplace with strong engagement and recurring activity. The results have been impressive. During the first quarter of 2026, U.S. gross merchandise volume in collectibles increased an outstanding 27% compared to the previous year. That is remarkable growth for a company that many investors once viewed as slow-moving. Strong merchandise volume translated into stronger financial performance. Total revenue increased 19% year-over-year during the same quarter. Those numbers demonstrate that management's strategic focus is paying off. Instead of spreading resources across countless initiatives, the company concentrated on areas where it could build meaningful competitive advantages. Another major reason to pay attention to eBay is its aggressive adoption of artificial intelligence. AI has become one of the biggest technology themes in the market, but not every company uses it in ways that actually improve the customer experience. eBay appears to be doing exactly that. One of the biggest frustrations for casual sellers has always been creating product listings. Writing detailed descriptions, entering specifications, and uploading information can be time-consuming. Many people simply decide it is not worth the effort. That creates friction. Friction reduces listings. Fewer listings reduce buyer selection. Artificial intelligence is helping solve that problem. The platform now uses AI-powered tools that automatically generate and autofill product descriptions, making it significantly easier for users to list items. What sounds like a simple convenience could have enormous long-term implications. When listing becomes easier, more people participate. As more people participate, inventory expands. As inventory expands, buyers have more choices. More buyers attract more sellers. That creates a classic network effect. Network effects are among the strongest competitive advantages any marketplace can possess. Every additional buyer increases value for sellers. Every additional seller increases value for buyers. The ecosystem strengthens itself over time. Management has already reported meaningful increases in casual fashion listings following the rollout of these AI tools. If similar improvements spread across additional product categories, overall marketplace activity could continue accelerating over the next several years. Another area quietly becoming an important contributor is advertising. Many investors still think of eBay primarily as a transaction platform. Increasingly, however, it is becoming an advertising business as well. Today, advertising accounts for nearly 19% of total company revenue. That is significant. Advertising generally carries higher profit margins than many other business activities. As more merchants compete for visibility on the platform, advertising becomes increasingly valuable. This creates another revenue stream that is largely independent of transaction fees. Diversified revenue sources often make businesses more resilient. Instead of relying entirely on one engine of growth, management now has multiple levers it can pull. Marketplace activity, advertising, artificial intelligence-driven productivity improvements, strategic category expansion. Together, these initiatives are strengthening the overall business. Another attractive feature is the company's financial discipline. Because eBay operates an asset-light marketplace, it generates healthy cash flow. Strong cash generation gives management flexibility. The company can invest in technology. It can improve the platform. It can pursue acquisitions if attractive opportunities arise. And it can return capital to shareholders while continuing to strengthen the business. That financial flexibility becomes particularly valuable during periods of economic uncertainty. Businesses with healthy cash generation often emerge from challenging environments even stronger than before. Valuation also deserves attention. Despite the company's improving momentum throughout 2026, shares continue trading around a forward price-to-earnings multiple of approximately 18. Considering accelerating revenue growth, expanding advertising revenue, improving marketplace engagement, and AI-driven operational improvements, that valuation appears surprisingly reasonable. Investors often pay significantly higher multiples for companies delivering comparable growth. Of course, there are risks. Consumer spending can fluctuate. Marketplace competition remains intense. Changes in online shopping behavior could affect transaction volumes. Execution around artificial intelligence must continue delivering measurable improvements. However, what makes eBay interesting today is that expectations remain relatively balanced. The stock is not priced for perfection. Instead, investors appear to be gradually recognizing that the turnaround is becoming increasingly tangible. The company is no longer simply maintaining its marketplace. It is actively modernizing it. It is reducing friction for sellers. It is creating better experiences for buyers. It is expanding into higher value categories, and it is building additional revenue streams that could continue compounding over time. Sometimes the market becomes so focused on the newest technology companies that it overlooks established businesses quietly becoming stronger every quarter. Those opportunities can often produce excellent long-term returns because improving fundamentals eventually attract investor attention. eBay may very well fit into that category. A business once considered mature is demonstrating renewed momentum. Revenue growth has accelerated, marketplace engagement continues improving, artificial intelligence is making participation easier than ever, advertising is becoming an increasingly meaningful contributor, and valuation remains attractive relative to the company's improving outlook. That combination is exactly what many long-term investors look for when searching for businesses capable of outperforming over the next several years. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Our third and final growth stock is Celsius Holdings, ticker symbol CELH. One of the biggest mistakes investors make is assuming that a stock's past performance determines its future potential. When a stock falls sharply, many people simply move on and assume the growth story is over. But sometimes, the underlying business remains strong while short-term expectations simply become too optimistic. When those expectations reset, the company gets an opportunity to prove itself all over again. That appears to be exactly where Celsius finds itself today. Just a few years ago, this was one of the hottest growth stories in the market. Then came slowing growth expectations, profit-taking, and a sharp decline in the share price. Many investors wrote the company off. But great businesses often reveal themselves during periods when investor sentiment is weak. Instead of collapsing, Celsius continued investing in its products, expanding its distribution network, and strengthening its competitive position. Now the financial results are beginning to reflect those efforts. The first quarter of 2026 was a major turning point. Revenue surged an incredible 138% year-over-year. That kind of top-line acceleration immediately grabs investors' attention. Of course, part of that growth came from the company's acquisitions of Alani Nu and Rockstar Energy. Those acquisitions significantly expanded Celsius's scale and broadened its product portfolio. Some investors immediately dismiss acquisition-driven growth. That would be a mistake. The more important question is whether management can successfully integrate those brands and create additional value over time. In Celsius's case, there are strong reasons to believe the answer could be yes. The company already possesses one of the most valuable competitive advantages in the beverage industry. Its relationship with PepsiCo has dramatically expanded its distribution capabilities. Distribution is often the deciding factor in consumer packaged goods. You can create the best beverage in the world, but if customers cannot easily find it, sales will always remain limited. PepsiCo's massive distribution network gives Celsius access to retailers and markets that would have taken years, if not decades, to build independently. That relationship has already played an enormous role in the company's growth. Now, with additional beverage brands under its umbrella, Celsius has an opportunity to leverage that same distribution infrastructure even more effectively. That creates operating leverage. Instead of building new logistics systems from scratch, management can utilize existing relationships to place more products in more stores around the world. That is one reason acquisitions could generate value well beyond their initial revenue contribution, but acquisitions alone are not the real investment story. The real story is that the flagship Celsius brand continues growing on its own. During the first quarter, core Celsius brand revenue increased 6% year-over-year. At first glance, that may not sound extraordinary compared to the headline growth rate. However, maintaining positive growth while simultaneously integrating multiple acquisitions demonstrates that consumer demand for the original brand remains healthy. Consumers continue embracing the company's positioning around fitness, wellness, and healthier energy. That positioning has helped Celsius distinguish itself within one of the fastest-growing beverage categories. Energy drinks continue generating some of the strongest unit sales growth across retail. Industry data from Circana shows the category continues outpacing numerous everyday consumer staples, including fresh fruit, yogurt, and beef. That tells us something important. Consumer demand for energy beverages remains extremely resilient. Within that category, Celsius has built an identity that looks different from traditional energy drink brands. Instead of focusing primarily on extreme sports or gaming culture, the company centered its marketing around fitness, active lifestyles, and wellness. That strategy has resonated with health-conscious consumers who want energy products aligned with their lifestyle choices. Brand positioning matters. Consumers increasingly purchase products that reflect how they see themselves. For many buyers, Celsius represents more than just another beverage. It represents an active lifestyle. Those emotional connections often create stronger customer loyalty over time. Another encouraging factor is the company's expanding scale. As revenue grows, management gains additional resources to invest in product development, marketing, international expansion, and operational efficiency. Larger businesses often negotiate better terms with suppliers, improve manufacturing efficiency, and spread fixed costs across greater sales volumes. That creates opportunities for margin expansion over time. Long-term investors understand that earnings growth often accelerates once scale begins working in the company's favor. Valuation is another reason this stock deserves attention. Despite the company's improving outlook, Celsius currently trades around a forward price-to-earnings multiple of approximately 19. For a business operating in one of the fastest-growing beverage categories, with expanding distribution, multiple growth brands, and meaningful international opportunities, many investors would argue that this valuation still leaves room for appreciation if management continues executing successfully. Of course, risks remain. Consumer tastes can evolve. Competition in beverages never stands still. Execution surrounding acquisitions must remain disciplined. International expansion always presents operational challenges. These risks deserve careful consideration. However, investing is about probabilities, not certainties. When investors evaluate Celsius today, they are looking at a company with several powerful growth drivers working simultaneously. A rapidly expanding energy drink category, a recognizable premium wellness brand, a dramatically larger product portfolio following acquisitions, an exceptional global distribution relationship, and a valuation that does not appear excessive considering the company's long-term opportunities. Those ingredients create an interesting investment case. When markets become volatile, investors often search for companies capable of growing regardless of broader economic uncertainty. Consumer brands with strong customer loyalty, expanding distribution, and attractive market positioning frequently fit that description. Celsius appears to be steadily moving back into that category. So when we step back and compare all three companies featured in today's video, an interesting pattern begins to emerge. Each business operates in a completely different industry. One is building a premium global consumer brand through innovation. Another is reinventing an established digital marketplace through artificial intelligence and strategic execution. The third is capitalizing on changing consumer preferences while leveraging world-class distribution to expand rapidly. Yet they all share something very important. They continue growing, they continue strengthening their competitive advantages, and they continue trading at valuations that many long-term investors would consider reasonable relative to their future potential. That combination is not always easy to find. Growth stocks often become so expensive that future returns become difficult to justify. These three businesses appear to offer a different profile. Strong businesses, multiple long-term catalysts, reasonable valuations, and management teams that continue executing against clearly defined strategies. Will every one of these companies outperform over the next decade? No one can answer that with certainty, but if each business continues executing the way it has over the past several quarters, it would not be surprising to see all three become significantly larger companies over time. That is ultimately what long-term investing is all about. Finding businesses with durable competitive advantages before their full potential becomes widely recognized by the broader market. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I'd like to hear from you. Which of these three companies do you believe has the strongest long-term competitive advantage? On Holding, eBay, or Celsius Holdings? And which one would you feel most confident holding for the next 10 years? Let us know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.